it's sort of been like an Alchemist experience because it's morphed and changed, and it keeps experimenting, and every event's different. So I'm very excited for this event, and the success of the event is always sort of a function of the chemistry between you guys and these guys. So this is your time in the next 2 hours. The whole intention is for you to ask the questions and get the insights that you normally don't get, and you're in for a treat. But before I tell you why you're in for a treat and tell you who's on the panel, I'm going to start off with a quick story. And this is a story I told actually at a similar panel that Howard was on last year. But there's this cartoon which I think resonates really well with the fundraising experience, where there was this kindergarten teacher who was telling her class that she wanted to teach the class how to draw. And so she told the kids, she said, okay, for the next 15 minutes, I want you to draw something and show the class. And she went around the room, and there was this one kid who was really intensely drawing, really passionately and feverishly. And she went up to the kid and she said, what are you drawing? And she said, I'm drawing God. And the teacher said, oh, but nobody knows what God looks like. And the kid said, well, they're going to know in 60 seconds. And it's that type of mentality that I think most entrepreneurs have, is you have this feverish pitch where you're like, oh, the world is going to get my vision. And it's up to these guys, well, to give you the blessing to move forward. The interesting thing about this panel is that we sort of wanted to choose a traditional top-tier venture guy, somebody representing the angel community, and somebody representing the entrepreneur community. But the hidden secret is that these guys are all like those gobstoppers, those like multi-layered gobstoppers that have different flavors, where they're each they have a veneer of a new thing that they're doing right now, but each of them could actually fill any one of those three roles, because each of them have played or are playing traditional VC, angel, or entrepreneur. But we're going to try to polarize them and get some interesting, good debates and tensions along the way. So, with that said, let me first see who's here. So, how many people right now are looking to start a company? How many people are starting a company right now? Okay. How many people are engineers or technical by background?
Yay.
Okay. How many people? Should we do the age demographics?
No.
No. Okay. Any other? How many people have done a startup before that they've gotten venture funding from? Oh, that's interesting. So it's sort of sophisticated. How many people have used AngelList? AngelList, yeah. Okay. Okay. Okay, cool. Any other?
How many want to?
How many people want to get access to Naval tonight? Okay. Cool. So let me start off then by going down the line and telling you who you guys get to meet with tonight. And each of these guys is going to give you their own, we're going to kick off with their own pearls of wisdom. But let me first start off by introducing you guys to the people here. The first person we have to my right is Patrick. Patrick Chang is the CEO of 5 Apes, which is a phenomenal stealth company. So if I had a sibling that was an engineer and that was asking me which company to join, this is the company I would tell them to go and try to get in on. So I don't know if Patrick's going to tell you what they're doing, but it is truly game-changing. And it is something, it's a technology that's been developed over the last 10 years, and it's one of these things that's in the artificial intelligence, machine learning, pattern recognition space that can change the world across a lot of different realms and verticals. They are selectively looking for really high quality, talented engineers, especially iOS developers. And while Patrick's not here to talk about that, he's going to talk about his historical experience. If you are an engineer, this is not a company to miss. So Patrick, before 5 Apes, was the founder of Aleph and Jawbone. How many people you have a job? Yeah.
Clarification.
Sorry.
I wasn't the founder.
Or a co-founder. Part of the founding team.
Part of the original team.
Okay. Which number were you?
I think I was number 6.
Okay.
I was the first non-engineer.
He was the first non-engineer, and the reason why you're here tonight is because he also led the fundraising process. And who did you raise money from or close on?
We raised 3 rounds, totaling $43 million. The first was from Mayfield in 2002. The second was from Coastal Ventures in 2007. And then the third was from Sequoia in 2007.
And who led that fundraising process?
What do you mean?
Within the team, who was the individual?
On the VC side or on my side?
On your side.
So it was myself and the CEO.
Right. Okay. So, not bad funds.
Right answer. That's the right answer.
That is actually that's really true. That is the right answer. So Patrick's a rarity. Just to have 3 rounds of funding, to have any round of funding from any one of those funds is phenomenal, let alone 3. Patrick is also had a short stint on the VC side at Lightspeed. He's got an MBA from Harvard, a bachelor's from Berkeley, and is also a former operator and business guy from LoudCloud and Opsware, and is a triple threat. So please welcome Patrick. Okay, next to Patrick, we have Howard Hartenbaum, who's a partner at August Capital. So Howard, which companies is August Capital funded? How many people have heard of August Capital? Oh, okay. So maybe
Yeah, we can skip that.
You don't want to say? Okay.
I mean, I can count all my companies. I love them all.
Okay. Oh no, I mean August as a fund. I'm gonna get to yours.
I'll do that later.
Okay. So Howard is a prestigious member of the Forbes Midas list, having been the founding investors in companies like Skype, and also an investor in Bebo and a whole host of others. He's also a geek. He's an MIT alum. He's held engineering positions as well as business positions. He's worked overseas for 10 years, and most importantly, he's one of those guys who will always tell you exactly what he thinks, and it's usually really, really fun. So please welcome Howard. And next we have Naval. Naval is changing the dynamics of how seed and venture investing works. He's shifting it so that one day it'll be the VCs out there in the audience and the entrepreneurs up here on the panel. So he's bringing you lots of angel funding as the co-creator. Is that the term?
Sure.
Or
Co-whatever.
the co-maintainer of AngelList. He's a Silicon Valley vet who's shaped the Valley in a bunch of different ways, including being the author of Venture Hacks, the founder of the co-author with Nivi.
My co-author sitting back there.
Oh, hey Nivi. Okay, maybe Nivi can come up later. With the co-author with Nivi of Venture Hacks, and also the founder of 3 startups. Couple opinions.
I think like everyone in the audience, like for every one startup you admit to starting, there's like 5 or 10 you tried or you don't really admit to, so we could be here all night.
Okay, but some notable ones are like Opinions, Vast, Genoa, and he's an investor and advisor in a whole bunch of cool companies, including Twitter, Foursquare, and a bunch of others. He's got a bachelor's in computer science from Dartmouth. Please welcome Naval. So we're going to start the process off by the topic's on fundraising, and we're going to start the process off by having each of these guys have sort of created their own cogent thoughts that they want to share with you. And then there'll be a bunch of different games that we'll play to get your guys' involvement. So I'm going to start by just going down the line and starting with Patrick to share whatever thoughts he wants. Is it on?
So I hope everybody can just hear me without the microphone. So I imagine you guys are all here mostly to see Howard and Naval, but I'll give you a little bit of kind of my background as well and share some of my thoughts on this topic, which is actually the timing of this panel is actually really good for me because I left my last company, Aleph, earlier in 2010 and partnered with a technologist sometime last year, and we.
Sorry. This is for the video, not
Sure. And we are actually contemplating raising money right now. So some of the things I'm thinking about, I imagine many of you are also thinking about. So I thought I'd share some of those things, and Howard and Naval can tell me I'm wrong in all of them. But I think timing is a little bit of everything, right? Everything I'm about to say is really based on. It kind of boils down to what options you have and what your alternatives are. For me. We weren't originally looking to raise money at this point. We raised about $1 million in a seed round that we have most of still. And, excuse me, but as I've talked to some of my...
ask you to hold it?
Sure.
Sorry.
I'll just hold
This
this
is for
one.
the
I'll hold
video.
this one.
Okay. You don't need it.
As I've talked to people I've known in the venture industry, just kind of catching up and letting them know what I'm doing, I'm starting to... And people like Robbie who give me advice, I'm seeing that, the market timing is actually great for raising money for some startups. What I would say is, when I first raised money with the CEO of Aleph, back in 2002, that was a terrible time. We had $800 in the bank. We were all in our mid-20s, and first-time entrepreneurs with no background in consumer electronics, and we had a business plan for a consumer electronics play, which is a sector that's not exactly at the top of the list for VCs. And so essentially, we didn't have very many options. We were lucky to get a term sheet from Mayfield, and a great firm, and we were lucky to get them, and we're very fortunate to have them. But everything comes down to timing a little bit. So as we're looking right now on what we want to do, we think about it, and I know the market is open right now to raise money at what I'm seeing out there for pretty attractive terms, valuations, and large sums of money. And as we look at what it might be 6, 9, 12 months from now, I just don't know. So could I use the money right now to accelerate some of my development if it's available? So I'm actually starting to think about some of these things that I wasn't thinking about before. But the best part of this is also the fact that I would be raising money when I have options and alternatives. So if the terms just weren't right, I could still go with my original path and launch 3 or 4 products and see what happens, right? So again, I think this, for me, it's about timing right now and taking advantage of the opportunities out there. I would say a lot of people have talked to me about raising money behind momentum, and I would say, when we raised the second and third round from Khosla and Sequoia, it was a much easier process than when we did it originally with Mayfield, because we had a hot product. We were the top-selling Bluetooth headset in the marketplace, and we were stocked out everywhere, right? So it was a much easier process. But that being said, there was a good 4 years in between that time frame when we had to bootstrap again, because you just can't always predict momentum. And so what I would say is, yes, it's great to raise behind momentum, but at the same time, it may take you longer than you think to get that user traction and more iterations. And often, to me, it does. We're not as lucky as the Groupon guys or the Twitter guys. I think the other thing I would say is, that being said, I don't want to just start a process without being smart about it, because fundraising for a company, as many of you guys probably have already experienced, is pretty distracting to the business. It takes you, and the timing isn't always up to you, it's up to the investor. It takes you away from building product, hiring people. So I wouldn't say just go test the water every month or something. Be serious about it, but at the same time, be opportunistic. Now, in terms of how much we would raise, right? So people have asked me that. Are you going to do a Series A and try to get 5 million or whatever? Or are you just going to get a smaller chunk to get you to the next milestone? I would say, again, it boils down to your options and what's available to you and how attractive it is. But to me, what I would target to kind of maximize my opportunity for success and minimize dilution, if possible, is I would think about what it's going to take for me to get to the next major milestone. And then I would add on a little bit more, because my experience in the last 3 companies I've been in, it always takes longer than you think it will, and it always costs more than you think it will. So I would raise a little bit more than I would think I need. And then the final thing I was going to talk about for this is, how do I pick who I partner with, right? And again, it boils down to options. In 2002, and we were very lucky to have Mayfield, but we didn't have any other options. It was the only term sheet we got, and we took it because it gave us life to really realize our dreams, right? Or at least have a shot at it. What I would say though is, when you do have options, I think a lot of the mistake I see a lot of my friends making is they get so enamored with a firm's name that they forget about who the individual is that they're partnering with. To me, it's much, much more important who the individual is than the actual firm name. And I don't want to minimize the value of the reputation. Sequoia definitely helped us recruit. Having the name Sequoia, being a Sequoia company, helped us recruit. And you may say that, may look at who I raised money from and say oh, well, you raised it from Khosla and Sequoia, and you're telling me not to think about firm names. The reason we raised money from Khosla was because David Wyden, who sat on our board, the partner from Khosla, made the company-saving introduction for Aleph. The company was almost out of business, and he introduced us, when he was still at Tellme, he introduced us to the CMO of AT&T Wireless. And that one introduction is what enabled Aleph to really come out of the ashes and grow from $1 million in revenue in '06 to $56 million in '07 to $140 million in '08. Without that introduction, maybe we could have made it, but maybe we wouldn't have. And so that's why we chose Khosla, not necessarily Khosla, the name itself. Sequoia, Roloff was somebody we met in '03. He chose not to invest at that time, but he stayed engaged and helped us and gave us advice and introductions as much as anybody who wasn't an investor would, right? And so we appreciated that long-standing relationship, and that's why we raised money from him. And I would say in terms of how I would approach a VC, and I'd actually really be interested in hearing Naval's perspective on this too. But for me personally, my experience has been that I wouldn't just blindly email or send in a cold call. I would find somebody that I knew in my network that knew the person that I identified that might be a good fit for my company, and try to get an introduction that way, because they'll take you much more seriously when it comes from a trusted source. And the final thing I'll kind of say, and I'll stop talking, is I get asked sometimes by some of my friends about whether you should invest, you should talk to an associate or a principal at a firm, or just hold out for the partners. And my perspective on this, and the fear is that you're just adding a layer of rejection that could be in there. But my perspective is, it really, again, depends on the people. I found in certain company situations, the principal or the senior associate is really hungry and driven and smart, and they don't have a huge portfolio of companies that they're managing or that they're working with. So they may go the extra mile, and I've seen this happen in other cases. So I think, it boils down to the people. But that's kind of all the things I'm thinking about right now, so hopefully that helps.
Thank you. Howard.
So I couldn't agree more that the people that you choose to work with are much, much more important than the firm name. And I think a lot of entrepreneurs are very enamored with some big names and think that that's the way to go. But the real challenge, I think, in fundraising is, if you have something that's interesting and can be a good business, you have some work to do before you decide how to proceed. And a lot of entrepreneurs, they say, I need money. And so who can introduce me to somebody who's got money? Because when they see what I've got, somebody's going to give me some money, and they kind of don't look enough into the whole process that's involved. I think the most valuable thing for an entrepreneur to do who has not raised money before is to find somebody that they can trust as a mentor, somebody who's gone through the process of doing it, that can give it to you straight and is not biased in any way. I mean, sometimes I get great deal flow from lawyers, but then I've seen other lawyers say, oh, don't take money from that firm, take it from this firm. And if you ask them why, they say, well, because we haven't taken money from that firm lately. And so they're giving, I don't mean to pick on lawyers in general, but one general thing is,
and
a lot of...
especially not Greenberg Torig.
Yeah. It's just as an example, a lot of people will give you advice that's more in their best interest than in your best interest. And you really have to, you ask 10 different people, you'll get sometimes 10 different recommendations of what you should do. So you should always be thinking, why is this person giving me this recommendation? When I was an entrepreneur, I was a VP of biz dev at an enterprise software company, and the CEO just summarily quit one day. He made about $50 million selling his stock in a prior company that went public. And all the guys sat around the table and said, okay, Howard, you're the CEO now. And frankly, I didn't know, what does a CEO do? And so I went and found somebody as kind of a trusted advisor, a guy named Rick Miley, who had founded Global Village, which was backed by Mike Moritz and taken public. And Rick became my mentor and my teacher to help me through the whole process. And I said to him, what does the CEO do? And he said, well, that's the cash extraction officer. Your job is to go and get the money. And let me teach you how angels think. Let me teach you how VCs think. Let me explain to you what their motivations are and what they're looking for. And if I hadn't had that, I think it would have never, my future in that business wouldn't have worked out, and my progression into angel investing and then super angel investing and then venture capital investing, which I've done all of them. So I think the most important message for you guys is, if you don't have the experience in fundraising, is go and find at least one person that you truly feel you can trust, who has that experience, who will give it to you straight. And then it's kind of a question of what are you looking for. And I fully agree the person is the most important thing. Whether they're an angel or a super angel or an angel consortium or a micro cap VC or a large VC, in the end, you need money, but you also have certain requirements. Some entrepreneurs want very high touch. They want people to tell them, tell me what I should do next, or what recommendations do you have for me? I want somebody who was a heavy operator before, because I don't have that experience. Or some entrepreneurs are like, I don't want the investors bothering me at all. I want good, structure on the board, but I don't want a guy who comes and tells me how to run my company, or I don't even want advice. I just want introductions when I need them. And so if you kind of think, what do I want? That really helps you narrow down what type of investor that you want. And for example, if you're in an enterprise space, you probably don't want a consumer internet investor. Or if you're in the medical technology space, you don't want a guy who's focused on chip design or whatever. And so kind of map out what you think. Get your mentor and help you pick some people. I fully agree. An introduction. I mean, I get cold emails all the day, and very often I can't understand what the presentation is because it's not fully baked yet. But if it comes from somebody I know, then I'll figure that they've already screened it, and then I'll take the meeting and I'll have the meeting. So it's easy to say no. You want to have a reason to say yes in the process. In terms of, I guess we're going to talk a little bit about angels versus VCs versus super angels and stuff tonight. There seems to be in the Valley this kind of antagonistic, like angels versus VC. But if you look at all the interesting companies out there, both are involved. Look at any company right now, whether it's a wildly successful company like Groupon, or it's a company that's struggling. If you look at the ones that have been venture backed, they all have angels, and if you look at ones that have angels, they generally all have venture investors along as well. They play different roles within the company. Sometimes it's a mentor, sometimes it's somebody who was an operator in a related business in the past who can give you good advice about that market space. Sometimes it's a guy who backed a company that looks similar to that before, and there's just different traits that you're looking for. So don't get wrapped up in, oh, I can get an uncapped bridge note from this group of people, and then I can maximize the valuation from that guy and kind of play that game. Pick the people that you think are going to help you the most in the business, and it may be an angel, it may be a super angel, it may be a VC, or it may be all of them combined in a mix. And map that out and then go do it. Don't just kind of run around, oh, let's pitch everybody who's willing to listen to me and hope that it works out in the end. So put a little bit more strategy behind it in the process. So I will pass the baton.
Great. Thanks, Howard.
Thank you, Howard. Agreed with what you said. You can divorce your spouse, you can break up with your partner, but you can't leave your VC. So once you take money, you're stuck. So it does make a lot of sense to be with someone who actually really believes in you as an individual, treats you like a peer, and will be comfortable through all the pivots and changes you're going to have to make, because it's never easy and it's never straightforward. I could spend 8 minutes talking about fundraising. I don't think it's a great use of time of trying to figure out how to do all the strategy, because frankly it's all sort of out there and commoditized information at this point. You can go to Venture Hacks and learn how to negotiate a term sheet. You go to AngelList, get your introductions. You can meet with any one of a number of advisors who can tell you how VCs or angels think, and the reality is that there is no single way that they think. These are all individuals just like yourselves, so it is a complicated moving thing. But fundamentally, I think raising money and fundraising strategy is it is a symptom of the underlying condition. The underlying condition is the health of your company. And so what you really need to focus on is just building a great company. Charlie Munger, who's Warren Buffett's partner, was asked, how do I find a worthy spouse? And he said, be worthy of a worthy spouse. And so in that sense, how do you find a great investor? Well, have a great company that's worth investing in. And AngelList, we see tons of companies. We're constantly screaming too. The workload is high. We're constantly screening them. We're constantly trying to help entrepreneurs get funded, and our mission is to get every worthy startup funded. And so we see a lot of companies, and I can tell you that there are basically 4 things that you end up looking at, and that is in order: it's traction, social proof, product, and team. And so those are the 4 things you have to work on. Team is a foundation. It's the basis. You got to have a great partner, someone you get along with, someone hopefully who you've worked with for a while and have a complementary skill set. It's really hard to do anything great on your own. So make sure your co-founder is someone who's willing to carry the load. You're not embarrassed to put them in front of an investor and can really represent their half or better of the business. completely. Right above that is product, especially with the internet, web, mobile products. It's very visual. You want something that can be easily demonstrated, something sexy, something that'll get people excited. Investors are users too, so they like to see products that they themselves will want to use. And some of the best investors, like I think Fred Wilson has practically made a career out of this, they use these products intensely, get very familiar with them, and then they seek out the entrepreneur and really have a great rapport with them. Right above that, I would say is social proof. Social proof, the bad version is monkey see, monkey do. The good version is you basically want to find people who believe in you. Start with entrepreneurs, friends of yours, who can then refer you to advisors who are well known and actually spend time with the company. And you can move up from there into the stack to angels, and you can get a few of them committed into the round, and then eventually to VCs who are investing more money, and so they're going to be a little more risk averse and rely on more social proof. And the king of all of these things is traction. Nothing competes with traction. If you have a graph that's going up and to the right, hopefully nonlinear, then the world is your oyster and you can raise money. So I don't believe in trying to really over-optimize fundraisings, as Howard said, on price or in terms of pounding the pavement or trying to meet hundreds of people or just working constantly on your pitch deck, refining your pitch deck. Your pitch deck should be an afterthought that springs out of a great company. So focus on the company. I think the fundraising is getting easier and easier.
Cool, thanks, Naval. I'm going to just ask 2 quick questions, and then we're going to have audience participation. We're going to play hot seat after that. So the first question is just, I think a lot of people still wrestle with funding strategy, with what does it take on when they should go out, because there's this perennial trade-off of if I have cash, I can do more, and if I don't get the cash, then that will change the plan that I should sort of go after. And I know there's a ton of different variables, but just to give a clean example, if you are a fantastic entrepreneur or engineer, so you have a great background, no product built yet, but you have a very specific market that you want to go after, and probably a team, a co-founder. Does it make sense to even try to see if you can raise a couple $100,000 of angel funding at that stage?
At that point, if it depends on what you're trying to build. If you're trying to build a semiconductor device and you have enormous experience as a semi-engineer, you might be able to raise money from experienced angels on the strength of your background and the product you're trying to build. If you're trying to build another social network, you better crank something out and have a lot of users using it, because the barrier to entry is just so low that the bar is higher. You may be able to raise money from angels at that point, but it's going to be friends and family angels, people who probably already know you and trust you and don't view real execution risk on it.
So could each of you guys just quickly give us 2 examples of a standard term sheet that you're seeing today, and for each example, tell us what are the top 3 salient characteristics of the company, and obviously these can be anonymized, and what was the pre-money, what was the amount that went in, and just those terms, just like at a very high level, to give people a sense of, and you can pick 2 examples, ideally try to make them sort of quintessential examples that might hit like a good percentage of scenarios that are out there. And if you can use the mic, that'd be helpful. Thank you.
So I'll start and I'll say, generally many entrepreneurs perceive if it's young and early, go to angels first and, cut your teeth there and then go to VCs. But I'll say the last 2 deals, and I'm not going to give exact numbers because I do so few, I do 2 or 3, maybe 3 deals in the past year. But I can give the dollar amounts, and you can draw some assumptions about the valuation from that. But in both cases, in one case, the company had a few $100K in angel money, and they needed money. It's a fairly complex business called Relay Rides, which is a peer-to-peer car-sharing business. It's basically Zipcar, but consumers own the cars as opposed to the company owning the cars. And they needed money to grow their business, and it wasn't going to be a few $100,000, so they came to talk to some VCs, and Google Ventures and August Capital split the deal, and we put $4.5 million split down the middle and bought into the company.
What % did you buy?
So that gives the exact valuation, but typically, so just as a rough point, you can calculate roughly what it was, but if a VC is going to put money in a company, you rarely see them buy less than, the range is usually somewhere between 15 and 25% of the company, and that's kind of the range. There's some VCs who will buy a little bit less, and some who, Fred Wilson buys a little bit less, and Sequoia buys a little bit more. But generally, they're kind of in that range. And that was a company, like I said, already had angels, but they needed millions of dollars to move forward, and they couldn't make the commitments to the hardware providers without having the backing that they needed. As an example for one company. Another is a company that I met 2 weeks ago on Friday night at 5 p.m. It's two guys out of Stanford. They showed me their demo. It's an alpha demo. It's kind of rough. I had them come in I took them to dinner Saturday night. I had them pitch our partners on Monday. I took them to dinner again on Monday. I spent all day Tuesday with them, and we shook hands on Wednesday. And they had no money in the company whatsoever, and the company raised $1,750,000. And so and I said to them, there might be some angels that would be interesting and have some specific experience, so why don't we leave another $250K open, and if you guys want to bring some angels in on the deal, that's totally fine with me as well. And even in the second closing, so that our thing is already done, and the deal will be closed, I think, Friday of this week. So
and you guys put in the 1.75.
And we put in 1.75. I would have put in $1 million with those guys, but they convinced me to put in more money. They did a good job negotiating. So,
cool. And do you want to say the percentage?
So I gave you the range of
you did.
percentage
Okay.
already.
Okay.
So, yeah.
Thanks, Howard.
Yeah.
Naval, do you want to give two prototypical?
There is no
examples?
prototypical deal. I think that especially at the angel level, the outcome follows a power law distribution, where a small number of the companies account for all the returns, and the majority of them don't do so well. So because of that, when you find a deal that is interesting and that obviously has traction or has someone who's really capable, everyone stampedes in, price goes up, everyone's fighting to get even small amounts in. And then on the flip side, there's a lot of companies that seem kind of reasonable, but they just can't get over that hurdle of getting the first investor. But I'll give you two examples to show you kind of the edges of the curve. There's one angel deal I did about a year ago where I put in $1 million, and there wasn't much there, but it was in a guy that I knew really, really well, and he'd started a company before that he'd taken public. And I gave him $1 million in convertible note, and two more angels came in for $500K each, and that got done on a handshake.
And that was without just the guy. That was backing an all-star.
And beyond all-star.
Beyond all-star.
Yeah, started a multi-billion-dollar company before,
Okay.
starting again from scratch, same space, knew his stuff, and straight execution business.
Okay.
Another example would be, and actually, I can't even say who it is. It's Gaurav Dhillon, the founder of Informatica.
Okay.
So he had done a company that had been public. He'd run it as a public company, went back in the same space, started SnapLogic. I invested in Andreessen Horowitz, just did a big round, put in $10 million into the company. On the other extreme, I think just yesterday, it's a guy that I've known for years, hardest working human being I know. He's always working. Never liked what he was doing, like him as an individual. His company blew up, fell apart. He's sort of down in his luck, ran off back to his home country, called me the other day, just really excited, described the idea. I wired him $50K. I'm still waiting for the terms and the paperwork. I don't know. Maybe I'll get the money back. Maybe I'll run off with it.
50K as a convertible debt, or just 50K and terms TBD later?
50K, and we didn't even have a convertible debt note lying around, so I'm probably in violation of some law.
Okay. Okay. So now we're gonna play hot seat. So how many people have been to one of these events before? Oh, not that many. Okay, so I'll just describe this. So it's much better when you stand. So the way this works is we want to invite people to come up and pose a real life situation that you're wrestling with, and in exchange for posing that, you want to present that situation tersely, like within 30 seconds. So just get to the core issue really, really quickly, because everybody's time is really, really valuable. And the rules of hot seat are that you present your situation really, really concisely and tersely, and then these guys will be able to ask you whatever questions they have. And when they've gotten the answer they want from you, they'll say thank you, and that's the cue that somebody else can ask a question on the panel. And we'll try to do this like really, really quickly, so that they're going to be asking you like some quick questions, and then they'll give you their takeaways on the scenario. And we'll try to go through a few of these depending upon the desire and the speed with which we can go through them. So this is always a fun way to see like who are like the real risk takers, because going first involves taking a risk. Does anybody have a situation that they'd like to present? Cool. Okay, go. And you can do it just from where you're at. It's sort of.
It's great that game mechanics are being applied to everything, including panels.
Everything is a
Do I get points for this?
Huh?
Do I get points for this?
You do get points. You get 1 billion points for going first.
I'll take it.
It's convertible to gratitude.
All right. Hi, my name's Lorenz. I run a company called Find Me Fit. So I've self-funded the project so far, paid a developer. We developed a minimum viable product, and I'm at a point now where I'm out of money, been couch surfing for like the last year. And the product is a very good demo, but it's not good enough to go to market yet. So I'm in a situation where I'm trying to raise some money and also trying to find co-founders to build out the team. So co-founding engineer, co-founding marketing person. That's where I'm at and trying to figure out what the best way to do it. I find, when I go to investors, they're like, oh, well, show us traction. And when I go around trying to recruit people, they're like, oh, I need to get paid. So
Chicken and egg.
yeah, chicken and egg.
Any questions, or do you guys want to just?
It's a web or.
So it's a online site, kind of like a Yelp for local fitness activities. You can find any sort of activity like yoga, Pilates, whatever
I'll say
in
thank you
your.
whenever you've learned enough to thank you.
So you don't have a co-founder now?
I do not. I've funded a developer. Yeah.
But you have a team.
No, I do. It's just me right now. Yeah.
So you did all the development too.
I did the front end development. I paid a back end developer to build out the infrastructure. Yeah.
Howard, do you have somebody who's a mentor to you to give you some guidance on fundraising?
I've raised $6 million for my last company, so I've got a few people that kind of help me
What
out.
do you think is the biggest issue? I mean, in your heart, not just what you're hearing.
Mm.
What do you think the biggest issue is, and why you're having trouble raising money?
I think the product's not quite in the market yet, so the feedback we always get is, will people actually use this, and how will you get users?
Not the feedback, but what
Right,
do you
right.
think is the real reason?
I think that
Intellectual honesty.
intellectual honesty. I don't think I've done a good job articulating how we're going to get users, and that may be like the foggiest part in my mind as well.
Thank you.
Any comments?
Yeah, I liked Howard's Socratic method. But,
No,
yeah, I thought that was very clever. My personal take is that it's just really hard to do anything on your own. You need a co-founder, and that's kind of the high order bit. You should go find a great engineering co-founder, someone who is as passionate about the space as you obviously are, will hack on it for a while, even if there's no money. That's the definition of a co-founder, and therefore move the business forward. And as the business moves forward, I think the money will show up.
And I'll elaborate that a little bit deeper, which is many, if not all, investors are looking for a natural leader. And a leader is defined as somebody who has followers. So if you don't have somebody in there with you, it's sort of like from all the people, I don't know you at all, but from all the people you know in the world, nobody was willing to join you is kind of makes me nervous that maybe everybody who knows you doesn't believe in it either. So why should I believe?
Patrick?
Yeah, I agree. I mean, I think I'm going to basically restate what they said, but I'll give you an anecdote to that. So when I joined Ala, as Ravi mentioned, it was 5 engineers in one bedroom apartment. Literally, we had $800 per day the first day I joined. And I said, how am I supposed to pay these bills? I was the CFO of VP of Business Operations. And the CEO said, well, I'll call my uncle. He'll give us a line of credit. But that's, whatever. But the way we got, the way he convinced me to join, and the way he convinced other people to join us before we raised this round from Mayfield, was every single person that we brought in was passionate about what we did. We did demos. And our CEO is you guys may know him, I don't know. He's an unbelievable salesperson, and he's an engineer by training, but he's a salesperson at heart. And it's just the passion in what he said, and frankly the technology was pretty impressive, but the passion is what convinced everybody else, and everybody we picked was passionate too. So anybody you met in the company had that same passion, and we were all working there for free, without a guarantee. It wasn't like today, it was like 2002, so we had no guarantee that we were going to raise any money. And so to me, I agree, you have to find a partner. You have to be passionate about what you do. You have to find a technical partner that you think can balance you out, and balance your skill set out and your experience set out, but also shares that same passion.
Thanks. That was brilliant. See, I wish we had the mic on that, because that's like the story. Those are brilliant stories. So next time, let's start, please. Okay, thank you.
Thank you.
Thank you for going first. And I won't put the mic on the guys who are asking the questions so that it's all anonymous. It's just the panelists. And it's just like snippets like that of really good grandfatherly advice. Not that your grandfather.
So I'm the one who got shafted?
No, you didn't get drafted. It was a great.
Everyone else is anonymous, but I'm not.
Well,
Is anyone here in the audience technical and passionate about fitness? I tried.
Okay. Oh, you're trying to go up with the co-founder. Okay, who's next?
Playing the mic?
No, you can just speak.
Okay. So I'm building Kriya. Kriya is a Sanskrit word. It means positive action. So I'm building Kriya with 2 other people. We launched almost 7 weeks ago. It connects local people with fashion designers around them. And since we launched 7 weeks ago, we made money for most of our designers during the holiday season. We are at a point where our product is launched. We are making a little bit of money. We have new designs lined up to get featured on our site. Now, the thing we are wondering is if this is the right time to raise money and expand on it, or maybe we just build something more on top of what we have done so far. I'm just curious.
You want questions?
Yeah,
first?
questions. Do you have any
So do you
clarifying
feel
questions?
like you're selling promise now, like what it could be, or do you feel like you're selling reality, which is the data that you've aggregated?
We made real sales.
So you feel like you're selling reality?
Yes.
Okay,
We are
thank you.
solving a real
Thank you.
problem.
Yeah, just building on that, do you feel like you can scale the product as is, or will it have to make major changes before it can kind of be the real thing that you need it to be?
I think the product has, all the minimum features which are needed to add value to our customers, to our fashion designers. It's a matter of finding more of fashion designers and then getting the right number of users.
How are they finding you?
Initially, I reached out to them, but now we are getting contacted directly.
Patrick?
How much? What would raising money? What kind of meaningful progress could you make by raising money? What would it give you?
So right now, I'm doing the engineering as well as business development, finding new customers, and just to other people do graphic design and social media. So I'm doing right now 3 business jobs. If we have money, we can maybe hire some more people and then get more customers.
Thoughts? Howard?
No, I'm in the hot seat.
Yeah.
So I think, sorry. I asked the question about promise versus reality because I feel a little bit differently than Naval on on investing in especially in consumer companies, where if you can say what you're going to do, but you haven't done any of it yet, and people can believe that, sometimes it's easier to raise money on promise than on reality. And the most interesting companies I've invested in were ones where I believed in the promise and happened to be right, or the founders were right, and I was lucky enough to put money in. Like Skype, when we invested, and then after us, nobody would invest until after they launched and went crazy, but we had a low valuation and they didn't. So, I took the risk for it. So now that you're in reality, one of the challenges you face is now you have some data, and many investors are like, I want more data. So you're sort of bound into this, well, let's see how it goes for 2 more weeks. Let's see how it goes for 2 more weeks. And that can be a challenge in what you're doing, and unless you hit some inflection point, which is the ideal, beautiful company, which we rarely ever see, which is ones that just go, the Groupons. Then everybody wants in, and it's ridiculous. So you're in the reality phase now, and my guess is you'll probably face a lot of investors saying, this sounds pretty interesting, but come back to me in 3 months and tell me if the trend has continued. In order for you to get people to bite now,
Yeah, I got it.
you probably need like 5% weekly growth type of deal.
Naval or Patrick wanted?
Sorry, was that too
No,
long?
it was great. It was great. It was just I'm trying to be cognizant of time.
Game mechanics here. He's gaming us. I think it sounds pretty interesting. The devil's in the details. It's hard to tell exactly, but you seem like you're articulate, passionate, know like your market, and you're doing a little bit of everything. So it's kind of nice to see a jack of all trades founder. You've built a product. You're getting some traction in the marketplace. One of the things we're doing at AngelList is breaking out angels by markets. So maybe you could go after the fashion-oriented angels first, and I think we have a few dozen of those identified, and see if you can get some traction there. You get 1 or 2 of them to sign on, and then they can sort of avalanche. Howard is right. You can get caught in that trap where people always want to see more data. And one way to get past that is to show that you understand the microeconomics of your business really well. You understand the cost of customer acquisition, how to spread from one customer to another, and what the margin and the NPV of those customers are. And then you can basically say, I can take your money, use the following advertising or marketing channels, and scale the business up to this point.
Patrick?
Yes, essentially, I mean, that's basically why I was asking the question. Like, what progress can you make with the money you raise? Because if you can really show that scaling and that you can really convince somebody because you know the analytics of the data and you can show that it'll scale, then I think that to me would be a slightly easier sell. But you're right. I think a lot of consumer-facing e-commerce or consumer apps type companies really are based on traction, where it's just a takeoff success. Unless I think you find somebody, the unique person, who really just gets you, really gets what you're saying, really gets your model, and sees that little bit of traction and says, I'm going to take that bet, right? And so that's, again, getting back to one of my earlier comments, which is you find the right person that has the right experience, that has the right network, that has the right whatever. Maybe it's just a gut feel that they get you, they get what you're doing, and then maybe that can help you. So I don't know if I actually added anything, but.
Yes, thank you. That was great. Okay, who else? We'll go quickly. Yeah.
I've got two startups. One is I raised money off friends and family, now it's VC, and that's running. But my friends and family network's been tapped out on that first one. I'm starting a second one, which is a autoimmune therapy company. It is based on, let's say, a supplement kind of space rather than having to develop new molecules. In order to raise seed funding, raise working capital, I'm actually exporting supplements out of the country to various places in the world to get money. But to do the clinical trials I'm going to need a jump in cash at some point. The question I have, is it better to try to ride the back of exports as long as I can and to fund the clinical trials? Or is it better to do that and get funding now?
Can you run the clinical trials in another country where it's a lot cheaper?
Investigate that.
You have a lot of credibility in the space. I mean, it's your background.
Yeah, we have two world-class scientists on board. We have a very good team.
What happened to your last company?
It's fun. It's actually growing. Fortune 500 companies are investing in right now. We're going for another round. Actually.
Why did you leave?
Oh, I'm still there. I'm doing business development there.
Patrick?
So are you doing your new venture full time? No, then.
It's splitting. I share time.
Thank you.
Comments?
No further questions.
Comments?
Always a big red flag when people are splitting their time between two things. You know.
Got to commit.
I agree. In my brief stint in venture, any time that somebody came in and said, "Oh, I'm working at Google, but this is my side project," I was like, "Look, if you can't commit your career to this, then why are you asking so and so for money, right?"
Thanks. That's great comments. Okay, next. Yeah.
Hi, my name is Tony Wong. I'm a founder at Crumbs, which is a location-triggered messaging company. The question is following. The situation is following. First-time entrepreneur. This is a very young enterprise. About 4 months ago that we started. And the situation that I'm in is that even though there have been a number of milestones that we've accomplished in terms of setting up getting an alpha product, putting a board together, team, et cetera, when we go out for fundraising, the general question or the feedback that we get is we'd like to see some traction in the form of a launch product to user metrics. This is a surprise to me because I used to think of angels as people who were for launch that have the first entry of low enough so that you can do a launch. But on the other hand, I'm wondering whether or not getting the feedback straight from people, or is just another thing that just like you said, Howard, come back to us in 3 months once you see the user metrics and the
Yeah.
Has anybody asked to put money in at like a very, very low price? Like said, "Oh, well, would you take $200K for half the company?"
So when I tried to raise money, there was 25% of the round was needed from
Okay, thank you.
No,
Patrick?
I have no comment.
Okay, Patrick, any questions?
I guess you described it as, I think, a location-based service.
Location triggered messaging.
So I guess for me, I don't know enough about what that means, but I guess one of my questions was how crowded is your space? Are there a lot of competitors that are similar? Is there something you can point to, or is this something that you're totally starting that nobody else is doing, and it's hard to get investors to really understand what you're doing? Does that make sense?
Yeah, I think the problem is that location-based services in general is a very hot space, and therefore there's a lot of noise and difficulty, I feel, for investors is to distinguish what's signal from what's noise. And so they're all thinking that Foursquare and Facebook Places are going to take over the world in terms of location-based services, and therefore us coming up with a distinctive solution, at least in their perception, is hard for them to do that. But we
What-
do believe that we're differentiated.
Thank you.
Okay, any advice, guidance, feedback?
So my reaction is along the same lines, which is incredibly messy, complicated space. It's also very difficult historically to monetize, and you're facing an extreme uphill battle to raise money in a company like this.
You don't have to say anything.
I think the feedback you're getting is honest and straight. It is a very crowded space, so the way to break out is through traction.
And what if you don't know if the feedback you're getting is honest and straight? What other things can you do to make?
Then ask me.
Then ask Howard. Actually, so that's the other piece of advice: is ask somebody who's not get the third party involved, like an advisor or some intermediary. To
Don't ask your mom, ask Howard.
ask Howard. Howard will telepathically go there and figure it out. Okay. We'll do one more. Okay, Vlad, go.
Okay, my name is Vlad. I'm building a platform as a service. Basically, if you heard of Heroku, it's like a Heroku for Java. So my question is, I don't have a co-founder yet. I'm looking for one. And at what point should I try to get angel investment? Because that's my plan right now. Should I first try to build a product and then get investment, or should I first get investment, hire a small team, and build an even better product in less time?
How credible or well-known are you in the space?
Honestly. Well, I don't have any kind of notoriety, but I'm director of engineering at a social gaming company. I hired the team, from 0 to 10 engineers and 20 total employees. We launched one product. We're about to launch another. I've done I've started a company before that's profitable.
How come you haven't built some minimum viable product yet?
Well, it's actually a fairly complex product. So it's not something I can build on the side.
Come on, Heroku is just,
Patrick, what type of co-founder do you need?
Technical.
So you're more of a business product manager kind of guy.
I'm extremely technical, but it's a lot of work, and I could do it myself, but it would take a very long time. So I need someone to kind of be in the trenches with me.
Howard, questions? No. Comments?
I would say, you asked the right question, which is when should I fundraise? And I would say keep building, but find a co-founder, and then fundraise when you have a co-founder. That if I knew you, I might do it without a co-founder because I knew you could find one. But since I don't know you as an investor, I would like to at least see somebody else to help you out who believes as well. So keep building while you're looking for that guy, and then go ahead and fundraise. If you can't get a product out without having money, then get the co-founder and then go raise money.
Ditto, Patrick? Okay.
And any quick advice for finding co-founders?
These are perfect types of environments for doing stuff like that. Yeah, and I'm sure there's websites now, like co-founder websites and stuff like that, founder meetups, and yeah.
Yeah, okay. This guy wants to talk to you. There you go. Anybody else want to talk to Vlad afterwards?
Anyone?
They should.
Serious technical skills?
You got one right over there.
All right.
I can also tell you how I hooked up with my co-founder.
Yeah. Yeah.
So, sorry. I left Aleph, and I'll make this quick. I left Aleph earlier in 2010 because I wanted, the company had grown. I'd been there 8 years minus 2 years at business school, and I wanted to get back to the super early stage and build something again. And I was meeting with a lot of people in my network, not necessarily people that I thought could be co-founders, but I met with VC types, angel investors. I met with advisor type people like Ravi. And I just told people what I was interested in doing and who I was looking for. And I didn't necessarily, so I didn't go directly. It wasn't like a direct hit where I'm like, okay, I'm talking to you because you're a potential co-founder, right? I went and talked to a lot of people, spread the news of kind of that I was out kind of thinking about what I wanted to do next. And it just turned out that an investor that I knew had come across a technologist that had no business experience ever, but was really smart and developed something. And he's the one who connected us, actually. So the point of the story is, I wouldn't just go talk to people that you think could be potential co-founders. I would spread kind of the word of what you're trying to do and what you're looking for to just people in your network, and you might just fortuitously find somebody.
I think of it like getting married. It's probably someone you've already dated, so you probably already know them. And you're not going to Patrick's point, you're not going to approach people saying, hey, I'm looking for a spouse, right? You're going to kind of network and get to know them. So my guess is it might already be, and probably already is someone you've known and worked with in the past. You just think they're ungettable right now because they're locked up in some job or they need too much salary or they just didn't seem excited at first. But if you just pick the top 5 people you've ever worked with, or the top 3 even, have a very high bar and just keep working on them, you'd be surprised how often you can get one of them unstuck and end up with a co-founder.
Yeah, and the other end of the spectrum is you could go talk to somebody like Paul Graham who sees 50 guys a day or a week, and he might say, hey, I saw this team and I thought it was a stupid idea, but they were really smart guys, and maybe they should hook up with you because you've got a good idea. So somebody like that, or Ron Conway as well, people like that can make introductions to co-founders.
Cool. Okay. So now, I guess I should just Mike. We were gonna do a little bit of. I was gonna ask a few more questions, but if there's anything that anybody has a strong desire for, let me know. I'm what Jamie?
Co-founder. I wanted to discuss question what you guys thought about that.
What does pro-founder mean?
So pro-founder is this new platform for fundraising to get around this whole friends and family round, because you can't do it unless, or your lawyers will tell you, as they've told me, unless they're accredited investors, and then it excludes a lot of your community. So this is a way they kind of find this loophole and use exclusions and take care of the lawyer fees and everything for you. It's a way.
So it's a service. It's a company.
It's a online. It's a web service.
Okay.
And at least this is the way founder explained it.
Yeah, I could complete that one. It's the founder of Kiva, Jessica Jackley, and they take like an 8% fee, and they kind of help you. It's like a Kickstarter for raising money.
Yeah.
The problem is, so AngelList, we pick up where they leave off because we deal with accredited investors, so they invest for equity. Pro-founder, it's donationware. They can't take equity, so it's only good for raising small amounts of money, or if you have a product they're signing up to purchase in advance, like a Kickstarter.
And what's in it for the
Pro-founder, they
the
get
investors? Oh, I know they get a cut of the raise, right?
That's the problem. There's not much in it for the investors.
What do you mean? So it's literally a donation?
It's literally a donation.
It's like a loan. Okay.
But
Yeah.
the way she's explained it is that there's somehow they take care of all the terms so that it is able to be convertible, but
It's not, they can't buy equity. They can actually purchase debt against your revenues, but then you got to have a clear revenue generating business. So that might work for opening up a coffee shop, but it's not going to work for building a social network or a
Any other
iPhone app.
There's a saying, if you don't like what your lawyer tells you, get another lawyer. So many of the companies come in and they have unaccredited investors who they put money in the company. You just got to keep the number low so that you don't get inside of some violations by the SEC. So you can raise money from unaccredited investors, just keep the number low and I can imagine the lawyer just saying, oh, that's too much work and it won't be much money and you probably won't pay me for the time. So they might be trying to dissuade you, but you can take money from unaccredited investors. You just have to keep it clean and understand what you're doing.
Okay. A few quick questions. How do you know, are there any leading indicators to determine if an investor is going to be a good fit or not?
How they treat you when you're nobody.
Yeah, I would say that you don't really know because when you go out pitching, if you have something that's interesting, everybody's putting on their nice face. And everybody loves you and you love them and they take you to dinners and tell you how great you are and how much they love you. What you need to do if you think an investor might be interesting for you is reference check. Look at what the portfolio companies are on their page, or if they're an angel and they don't have a page, say, what have you invested in? Get the list, just pick 3 to 5 or 10 of their CEOs and call them up and say, hey, what is Naval like to work with? Is he emotional? Because the most important thing is reference checking, and we reference check you guys blindly and try and find people you used to work with or worked for you, and you should do exactly the same thing with any investor you're going to work with, and if you don't, you get what you deserve, because some of them may turn into monsters.
Patrick?
Absolutely.
They do that to you.
Yeah. We do it to you, and you should do it to us.
So the thing I would add to this is that investors are may treat you one way when things are going great, and treat you differently when things aren't so great. So I would, when I reference check, I would also look at companies that may not have been, that may have had a rocky period.
It may not be on their page anymore.
Yeah, exactly. So well, I'm not going to give that example, but.
Do you want to give the example off mine?
No, yeah, maybe I'll.
Okay, we'll cut the video. Actually, let's just turn the video. Let's just turn the video off. Is that okay? Okay, so now it's totally uncensored.